Every day, equity curves, bond yields, and currency pairs produce what looks like noise, a jagged time series with no clear pattern. Yet systematic strategies have repeatedly extracted alpha from something hidden inside that noise, stable, recurring cycles. The mathematical tool that turns this chaos into a frequency map is older than the exchanges themselves. It is the Fourier transform, and it works by asking a single, brutal question: how much of a particular rhythm exists in a sequence of prices? Over the next few minutes, we build that engine from scratch, with no prerequisite beyond a willingness to visualize rotation, and then deploy it on the kinds of signals quants actually trade. Imagine taking a snippet of daily S&P 500 returns, say, 250 days, and wrapping it tightly around a circle. Every data point becomes a vector. Its length equals the return magnitude, while its direction advances by a constant angle per day. That advance rate is the winding frequency. If the price sequence contains a rhythm matching that frequency, something striking happens. The vectors tend to point in the same direction, pulling the whole structure off-center. For frequencies that do not match, the vectors spread evenly around the circle, and the overall arrangement stays balanced. This single mental picture, a time series curled into a hula hoop, is the entire machinery behind frequency decomposition. All the calculus that follows is just a compact way of calculating that off-centeredness. The natural way to measure off-centeredness is the center of mass, or, in mathematical terms, the average of all those rotating vectors. For a given winding frequency f, we take each return observation r_n at time t_n, multiply it by a complex rotation factor e caret by 2 pi f t_n, and average over the sample. When f matches a genuine periodicity in the data, that average swings dramatically away from the origin. Its distance from zero is a direct proxy for the strength of that frequency. Crucially, this average is a complex number. Its real and imaginary parts tell us not only how strong the cycle is, but also where it sits in phase space, which matters enormously for timing signals. If we plot the center of mass's horizontal coordinate against the winding frequency, the result is a crude frequency spectrum. For a simple sine-like pattern, the curve stays flat near zero for most frequencies, then spikes at the signal's true period. In financial applications, we rarely have such purity, but the principle holds. A local peak in that spectrum indicates a rhythm. This peak resists random shuffling of the data. It is a structural feature, not a data snooping artifact, provided we validate it out of sample. As we tighten the sampling interval, the discrete average becomes an integral, and we approach the formal Fourier transform. What was a mental picture of winding a price chart around a pole becomes a rigorous, repeatable, automatable diagnostic for time series. This integral may look intimidating, but its meaning is identical to our winding center of mass, just taken to the limit of infinitesimal time steps and infinite horizon. The function g, t, is any signal, an intraday return stream, a volatility surface snapshot, or a macroeconomic diffusion index. The exponential term e caret I 2 pi ft is the rotating dial that wraps g, t, around the complex plane at frequency f. The integral accumulates how much g, t, persistently aligns with that rotation. Because we no longer divide by the time length, the resulting number scales with duration. A cycle that persists over many years produces an enormous spike at its characteristic frequency. This property makes the Fourier transform a superb long-cycle detector in multi-decade asset databases. Why drag complex arithmetic into finance? Because a single complex number captures both amplitude and phase simultaneously. In our transform, the output g, f, is complex. Its magnitude g, f, tells us how much energy sits at frequency f, while its argument gives the phase offset. For cycle timing, phase is everything. It tells us where we are in the cycle right now. A pure real-valued spectrum would lose that information entirely. Moreover, treating two-dimensional rotations through complex multiplication keeps formulas compact. The very same machinery that describes option payoff hedging in the complex plane can also decompose the underlying's realized variance into frequency bands, linking signal processing to volatility trading in a deeply non-obvious but powerful way. Euler's formula is the hidden engine that makes the Fourier transform both practical and computationally fast. It converts the abstract notion of rotation at a given frequency into a concrete sum of sinusoids. When we write e caret I 2 pi ft, we are really saying cosine 2 pi ft I sine 2 pi ft. That is, the winding vector traces a unit circle clockwise at f revolutions per unit time. In quantitative finance, this formula underpins the fast Fourier transform, FFT, which reduces the computational cost from O(n squared) to O(n log n). Without it, real-time spectral analysis of tick data would be impossible. The formula also reveals why a Fourier transform produces complex conjugates for negative frequencies, a property we exploit when designing bandpass filters to isolate, say, the 4-year presidential cycle from 60 years of SPX data. Real markets never give us a single pure frequency. A yield curve spread, for instance, is a superposition of monetary policy impulses, ultra-high frequency, inventory cycles, 1 to 3 years, business investment cycles, 5 to 8 years, and secular regime shifts, decades. The Fourier transform acts like a chemical centrifuge. When we pour this messy spread into the transform, each component frequency produces its own distinct spike in the spectrum, provided we have enough data to resolve it. The linearity of the transform guarantees that the spectrum of the sum is the sum of the spectra. This property is why quant shops can run PCA on a spectral matrix. They are decomposing the covariance of frequency components across assets, building what amounts to a spectral correlation matrix for risk budgeting. In quantitative finance, raw Fourier coefficients are rarely used directly. Instead, we square their magnitude to obtain the power spectral density, or PSD. The PSD is a real, non-negative function that tells us exactly how much variance of the original signal is attributable to each frequency band. For a daily return series, the PSD peak at 1/250 years -1 reveals the relative importance of annual seasonality. The area under the PSD curve between two frequencies gives the total variance contribution of that band. This decomposition is foundational to heteroscedasticity modeling. If volatility clusters in certain frequency bands, a GRCH model alone will misstructure that a spectral GRCH can capture. The PSD is also the natural input for constructing orthogonal signals in statistical arbitrage, because frequencies are uncorrelated under linear transforms. Apply the Fourier lens to the S&P 500 log total return index since 1950. The power spectrum reveals distinct peaks, one near 3.5 years, matching the classic inventory cycle, one near 7 to 8 years, linked to the business cycle, and a much lower frequency hump associated with the 40-year Kondrativ wave. A systematic strategy can isolate the 3.5-year component via a bandpass filter, zeroing out all frequencies outside a narrow window, and then reconstruct the filtered time series. That reconstructed series becomes a tactical allocation signal. When it turns upward, cyclical risk assets tend to outperform. Crucially, this signal is entirely data-driven, not dependent on NBR recession dating. Forward validation shows the spectral signal leads conventional macro indicators by 2 to 4 months on average, providing a genuine informational edge. Macro quants often face the opposite problem. Too many high-frequency wiggles obscure the signal. Here the Fourier transform becomes a low-pass filter. Take weekly data on capacity utilization, jobless claims, and industrial production. By retaining only frequencies below a cutoff, say, 12 months, we strip out the weekly noise and see the underlying trend months before a moving average would converge. The same filter applied to inflation expectations from break-even spreads can separate transient shocks from persistent regime shifts. Because the filter's design is linear and phase-preserving, we avoid the notorious lag of traditional smoothing methods. This spectral smoothing is now baked into several central bank nowcasting models, though the details remain guarded. For a systematic macro fund, it offers a cleaner view of the cyclical dynamics that drive currency and rates markets. Every spectral decomposition requires an inverse path. The inverse Fourier transform reconstructs the original time series G, T, by summing up, via integration, every frequency component weighted by its complex coefficient G, F. In practice, when we construct a bandpass filter, we simply set G, F, to 0 outside the desired band and apply the inverse transform. The resulting series is not a black box forecast, it is the component of the historical data that resides in that frequency band. This transparency is a powerful risk management tool. we can attribute each day's return to specific cycle components, answering the question, was this move driven by the short-term noise band or the mid-cycle momentum band? In a multi-strategy fund, such attribution prevents overweighting exposures to the same underlying frequency factor without realizing it. No quantitative tool is a mechanical license to print alpha. The Fourier transform assumes stationarity, that the statistical properties of the time series remain constant. Financial data violates this daily. Regime shifts alter the power spectrum, a cycle that dominated in the 1980s may vanish after 2000. A naive spectral strategy fitted in sample will overfit to ephemeral peaks and fail out of sample. Practitioners mitigate this by computing rolling spectra, testing spectral feature stability, and never trading a frequency unless it appears consistently across multiple decades and subperiods. Even then, spectral signals compete with crowded factor premiums, and their discoverability erodes returns. The real defensible edge lies not in finding a cycle, but in understanding the economic mechanism that sustains it, and having the patience to let spectral filters, not fear or greed, dictate entries. The Fourier transform is not a crystal ball, it is a diagnostic that peels back the superficial randomness of prices to reveal the rhythm beneath. For a quantitative analyst, that rhythmic structure translates into orthogonal risk premia, better timing signals, and a deeper understanding of how macro shocks propagate across frequencies. The mathematics, winding, complex exponentials, power spectra, is ultimately a disciplined way to ask one question: where are we in the cycle, and how strong is that cycle right now? Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.